Hello, everybody. Welcome to the Seattle Angel Meetup series. We're delighted to have you here. I'm subbing in for John Seacrest, who is in Europe talking to our Spanish and Portuguese and a variety of other country investors and entrepreneurs there as part of our international program. He'll be back in another week. And we'll take over again doing these workshops. I'm glad to help him all the time and delighted that you actually are here to join us. So thanks very much for coming along. Hi, John Benjamin. And this is going to be an informal fireside chat, and we're delighted to have Sharad and Allen join us today and give their wisdom. They've been doing investing in the angel space and beyond for a number of years, as part of the Seattle Angel conferences. And I'll describe a little bit about what those are in a second. So we're really focused on helping entrepreneurs and investors learn more about the angel investing ecosystem and how to be stronger in order to participate. Not everybody knows that they can be an angel investor, and so we'll put some links in case you're having some question about whether you also could participate in this. The SAC has some guidelines, and I'll put some links in there so you can just have a look. But here we're intended to give you some additional information so you know what you can participate in. If you're already doing it, we know that having a larger portfolio of small companies is better. And so this is an opportunity to hear about how you can diversify your portfolio and increase your success. We're also interested in entrepreneurs being stronger. And so we're holding our next session next week on how to build a guest profile, how to put things that are impactful into your profile. And we're delighted that Ali, who is on the line here and a founder of Harvest, will actually be sharing his guest profile so that we can learn some lessons about how to do that effectively. That's next Tuesday evening, 6 to 8 p.m. And I'll put the link in for that. So I'm Elizabeth Cross-Mickle. As I mentioned, I actually have a particular interest in health and life sciences. And so I also run the APIS Health Angels program. We run, in addition, the Transatlantic Angel Conference, which is part of Startup Accelerator. And that will be running at the same time as the SAC program this fall. Our investors start with our founders on August the 23rd. So if you want to participate, please let us know. Sharad, could I get you and Allen to introduce yourselves? You're going to do a better job than I am, and I'm excited to turn it directly to you.
Sure. Hey, welcome everyone. Very happy to be talking here with everyone, with Allen. So my name is Sharad, and I have been angel investing for about 8 years. I started off with SAC 6 and did a number of rounds of SAC, and then branched off, and some colleagues and I, fellow investors and I, we founded a sort of an angel network called Grubstakes, and we focus on mostly the Pacific Northwest, but we'll occasionally branch out and invest elsewhere as well. And so with that, I've built up a portfolio of about 25 investments, and I'm pretty happy with what I've done so far. So I'm looking forward to talking to all of you and seeing what help I can provide. Over to you, Allen.
Thanks, Sharad. Happy to be here talking to you guys and talking with Sharad about investing. Hi, my name is Allen Nieman. I have been a participant in SAC since SAC 11, I think. Also have invested through Grubstakes with Sharad as well on some investments, and been investing separately on my own with other people as well, and also was involved with the inaugural round of APIS Health Angels. So I first started angel investing, I would say, in 2017. I had the opportunity to invest in some other companies before that, but I didn't really know that I could invest in them at the time. And this is something we'll probably talk a little bit about here today. But I've been investing in various things, public and private, since probably I got my very first paycheck. So I've been doing things since then, and we could talk about public and private markets and all that sort of stuff, and non-equity related things and all kinds of good stuff today if you want to. But I'm excited to be here to talk to you all and share what I've learned, and hopefully drag some other people through the process as well. So happy to see you all, and everybody who might watch on video later.
Thanks very much. All right. Elaine, who's also participated with us since SAC 7, is just joining on board, but I'm actually going to, do you want to quickly introduce yourself, Elaine? Otherwise, we'll start off the questions. What's your first one, that burning question to ask Sharad and Allen? She may be not connected here. Okay, go ahead, Sharad.
Yeah, well, maybe maybe Alan and I can just get started talking a little bit, warm everyone up. So let me ask Alan. Hey, Alan, tell us a little bit more about how you got into angel investing. Why did you want to go do it, and what gave you the impetus and drive to do it?
Yeah, you bet. That's a great question. So like I mentioned, I would say, first introduced to angel investing, maybe 15 years ago or something like that. In the prior to the the 2008 crash, somewhere in there, I was introduced to it. And this is kind of part of my angel investing origin story, where as part of that introduction, the people that I knew that were investing in my head, and probably in reality, but also in my head, were maybe in that sort of ultra wealthy class of people. So they were making investments, they were doing things, they were part of bigger venture capital firms, things like this. And so in my head, I thought, these guys are writing these giant 6-figure checks or 7-figure checks or something like that. And so I didn't, as somebody who had been investing in lots of other things, but I didn't think that this was like something I could do. Right. I didn't know that. And so I passed on opportunities to invest, some of which went on to would have been successful outcomes had I invested in them. But I passed on them because I was uneducated. I was ignorant about the process. And so fast forward a little ways, I had gone through a process of startup process and selling process and a bunch of other things. And I was sort of just getting back into the startup world, if you will. And I had went to a meetup, and I met John Seacrest, who many of us have also met, and who is the impetus for many of us getting more educated and us trying to pass on that education here today. And he set me straight. He said, "Hey, why aren't you investing?" And I said, "Well, I'm not writing 6-figure checks for this sort of thing." And he said, "Oh, you don't have to do that. Let me tell you about how you can make this happen." And so that really opened my eyes into ways you can get involved and invest in startups, and so I started from that process. That was in 2017, writing that first check, and been writing checks ever since. And for me, initially, I honestly thought about it as like a triple bottom line. I thought to myself, sure, I can make money. That's the first bottom line. Maybe I'll make some money, right? That first bottom line. Second bottom line was that I'm going to learn a whole bunch of stuff, both as an investor and as a business person. I'm going to learn a tremendous amount. And the third bottom line is that I'm going to meet a whole bunch of interesting people. And I try to talk to college students now, for example, about, their life and what work might be like later on. And one of the stories I tell them is that the last time that I went to work someplace where I did not know somebody who already worked there, I was a teenager. So from that point until I just joined another startup, it's been because I know somebody, right? And it could be that I know somebody that knows somebody. It might be a third-degree connection or something like that. But I believe in that sort of third bottom line, that there's value in meeting people, not just because I might get value, but because I can provide value to them through introductions or what have you. So those sort of the three bottom lines for me of why I started. I saw the value in angel investing back in 2017. What about you, Sharad? How did you, what was the impetus for you to write that first check?
Yeah, thank you, Alan. So for me, and this is probably going to be a similar story to a lot of people. When I first started investing in anything was, soon after I got my first paycheck, and And of course, I started investing in the stock market, right? And I thought, hey, I'm smart. I can pick the winners, right? I can pick the winners in the market, and I did that for a while. And I realized, yeah, no, I can't pick the winners in the stock market. The game is rigged against me, right? So I very quickly realized, okay, I'm just gonna go to index funds and do some bonds and diversify my portfolio that way. And then that was fine. I was basically meeting market returns on those indices. But then I started doing some real estate investing. And again, as with anything, when you start investing in something new, you have to learn, right? You start out small, you learn a whole bunch, and then you see whether you can do a decent job, right? And I started getting some decent returns on real estate, and I was very happy with that. But there was just something something itching at the back of my head, telling me that, I've got a whole bunch of safe things in my portfolio. Real estate, relatively safe, indices and bonds. There has to be a little bit more in my portfolio that should be highly risky with the potential for high return. And angel investing was the thing that stood out to me. Right, I'm not otherwise a gambler. I don't otherwise go to Vegas and go roll the odds. And so I looked around and I was wondering, okay, is angel investing the right thing for me? And I didn't really know. I didn't know a whole lot of people. Actually, hardly knew anybody who did angel investing. But somehow, I got connected to John, and John, told me about angel investing. I knew a couple of people who were doing SAC. And so I joined, and it was an easy entry. It was really easy entry, right? Because the amount of capital that you have to put up to participate in a SAC round is very achievable. And then I learned a lot, right? By doing SAC multiple times. I forget how many rounds I've done. I've done maybe 6 rounds of SAC, and each time I learned, right? And I got more and more confident in my ability to make bets, but also I learned a whole lot of other really interesting things about how despite all the bravado and ego I might have, there's really no substitute for looking at an potential investment from multiple angles, from multiple eyes. And so after doing several rounds of SAC, I learned so much from John and all the other colleagues that I interacted with, that I decided to continue doing co-investing with fellow angels, through grub stakes and other entities. So that's sort of like a summary of how I got into angel investing.
And so, Sharad, you talked about sort of outsized risk and outsized returns. So you're getting like 100% IRR then, right? That's what we're targeting.
Yeah, it's awesome though. It would be so awesome if we can hit that, right?
Yeah.
So here's the math, right? So great question. Let's say we think that we can hit a 10x in an investment, right? And we're all talking about investing at a very early stage company, right? We're talking about seed, pre-seed, however you want to define it, right? So at this stage, a company is not going to go exit in a year or two. It's going to take about 10 years. So let's say best case, 10 years, 10x exit. If you do the math, that's 25% IRR, right? That's really not very, very high, right? So then you can start thinking about, okay, well, should I be going after 20x in 10 years? Well, that's 35% IRR, right? How much higher do you think you can get to, right? And then you want to compare that against the IRR that you get in other investments that you make, indices or real estate, right? With real estate, if, depending on how you do it, you might be able to achieve fairly decent IRR. Like I've been able to hit about 18% IRR. It's not as high as 25%, but, there's some trade-offs there. So what are your thoughts on IRRs and startup investing, Alan?
Yeah, yeah, I definitely think that one of the things I think about, whether it's with angel investing or other investments, is that if you want to if you want to achieve outsized returns, you have to do outsized risk. You have to take on other things that are out there, either through, like you mentioned, for example, you diversification. If you want to diversify your risk, you're also going to diversify your returns, right? So if what you're looking to achieve is market returns, then you can invest in the market and you'll get market returns out of that, minus a small fee, right? So it kind of depends on what you want. I think the key thing for people to think about with respect to startup investing, as Sharad mentioned, is that normally, at least some things we're talking about, we're making investments super early stage. And so there is definite risk that your investment could go to near zero. and I've had investments go to near zero in that situation. But talking about the math, what you're trying to get to by these early get to with these early investments is to get that 20x return, to get that 15x return, after a few years, 7, 10 years, 12 years out there. So all that starts to even out, right? So you can achieve that 20, 25% or higher overall portfolio return. So I think that when we think about, diversification, we can certainly talk about overall diversification, but when it comes to the idea of investing in startups, you definitely want to have some diversification. And you want to, if you're going to start investing in it, you probably want to think about what is my overall investable portfolio look like, and out of that, what can I allocate towards this particular very risky category, and within that, how do I slice that up so that I can make an investment in 10, 15, 20 different companies, right? And again, if I come back to that story I told earlier, Sharad, I was thinking we had to write these big checks, right? And so what I didn't learn, and what I would like everybody to know, is that by investing with other people together, you can write individual, much smaller checks than that, down to something that most people on the, not quite the average income in King County, but not far away from it probably, can get away with writing. When you invest with other people, now you can get that check size that's going to be necessary to invest within that company. And that overall check size could be that a startup will take, could be as low as, well, sometimes it gets really low, but let's say like $25,000 is usually about the minimum that a startup wants to take for various reasons. So if you think about that, you could get a situation where you and 4 other partners get together, invest $5,000, and you now have a $25,000 check that you can invest into a startup. So that's one of the things I really didn't know before I started getting involved and learned more about about what it takes to invest. And now there's a lot of information out there about syndication and stuff like that. But still, I think that not many people know that you could do that. $5,000. And when I think back to that first sort of $5,000 check that I wrote, in my head, I was also thinking, well, I could probably I'm like academically minded. So I was thinking I could take a class, right? I could take like a continuing education course at the University of Washington on entrepreneurship or on investing or whatever it might be. And that course is probably going to cost me $5,000. And at the end of that course, I'll learn something, right? But by doing something like Seattle Angel Conference or some of the other things that are available, you can sort of spend the same amount of money and you'll learn a bunch, and you at least have an opportunity to earn a return on that money. So that in my head, that was the easy, algebra that it took me to be like, this makes a lot of sense. I'm going to go ahead and do this. I'm going to learn a ton off a relatively small amount of money at risk, and there could be a return. That very first SAC check, no return on that yet. The company's going along though; it's all fine. But second SAC check, have a return from that. So that's happened. So yeah, pretty good stuff.
Very nice. So you hit upon a few really interesting things that I think we should talk more about, which is how much of your total portfolio to allocate to angel investing and how to slice and dice that. But before we talk about both of those, one more thing I want to say about IRRs is, to the numbers that I quoted, I wasn't factoring in taxes. Okay, so when I make returns on market investments or real estate, I'm filing tax returns on that, and some of, a third of it or a quarter of that goes away. But when it comes to angel investing, I highly recommend that every single angel investor really educate themselves on QSBS, specifically section 1244 and sections 1202 and 1045. Okay, so what that means is under section 1244, under certain conditions, if you incur a loss, those might be deductible from your ordinary income as opposed to your capital gains income. Okay, and that could have a significant impact on your how much percentage of tax loss you can take away. And then 1202 and 1045 talk about how your startup returns may not be taxable under a certain set of conditions. Now, you don't want to wait until after there's either a loss or an exit for you to go look these up. The reason is a variety of conditions of your investment may disqualify that investment from either of these categories. So for example, you want to think really hard about, am I writing a check into a safe note as opposed to a convertible note? Am I buying directly from the company, or is this a secondary sale? How much is that total round for, and how much has the company already raised prior to that? All of these things and many more factor into whether an investment qualifies. And unfortunately, I did not really educate myself on any of this stuff. And now that I'm, after many years of investing, I'm starting to see both losses and exits, and I go through the motions of calculating all of this stuff. I realized, hey, wait a minute, that is, sorry, yeah, so that makes me realize, yeah, some decisions I made could have been more optimal from a tax point of view.
Yeah, that's a really good point. That's a really good point. There was a hand up for a question, but maybe we can pause there, actually, Sharad, and just ask if there are any questions before we continue our interlocutor. No audience questions?
Thomas was going to
Sharad,
share.
Sorry. Sharad, can you share about the difference between safe and convertible note? The text difference, maybe just a short version, if you can.
Oh, gosh, yeah. So I'll give you a very brief version, as I'm not like I won't be able to recall all the differences. But the way to think about a safe versus a convertible note. So a convertible note is, think of it as a loan instrument. It's you're making an investment under effectively what look like loan, like a loan document, but with a promise of it converting into equity. And then there'll be some terms around that as to what is the interest rate that gets applied at the conversion. There might even be a discount at the conversion, and then there'll be terms around what a conversion event looks like. For example, if you raise a round that's 2 million or more, that might qualify as a conversion event. So that's effectively what a convertible note looks like. A safe is very different. And a safe is something that I think grew out of YC, if I'm not mistaken, and it is not at all like a convertible note. It's a much, much smaller and slimmed down document, and it's really more of a promise, I would say, rather than an investment in equity or a loan that converts to equity. Any more thoughts on that, Alan?
Yeah, I would say that what's important to understand about, well, okay, so a safe, I think, the origin of a safe was at YC. They were seeing a lot of entrepreneurs sort of taken advantage by bad paper, basically bad convertible note terms. And so out of that, they were like, look, this could be simplified, and we could provide this as a service to the startup community to say, if you're raising money, here's a method for raising money that's been vetted, that is at least neutral between investor and entrepreneur, rather than being sort of weighted one way or the other. And so they created that document for that. And they're not on version 1 anymore. There's been some revisions to that basic documents occurred over time. One thing that I think is important, Sharad, that you mentioned about that is that a safe is actually not a financial instrument. So if you're a financial minded person, you know, there is a note, a promissory note is a debt instrument. It's a true financial instrument. You know, it's a true financial instrument, like equity is a true financial instrument. A convertible note is a convertible promissory note, as Sharad mentioned, that upon some activity changes from debt to equity. But a safe is not a financial instrument. And so I think that's an important distinction. There's some distinction about that with you know, government regulators and IRS and you know, Sharad mentioned QSBS, and so there's a bunch of things around that you need to know, or need to be, you know, you need to become aware of. I would say that safes are more or less common in different parts of the country. They're very, very common in the Bay Area, where it kind of got its start. They're less common up and around the Pacific Northwest area. When people decline safes, I think other people outside the Valley tend to find that humorous because it's just so standard now down in California. But yeah, I think, again, the key point in my mind is that it's not a financial instrument. That's just kind of the key thing. So there's, you know, risk-related issues with that potentially. There's a number of things that could go sideways. Not that they have, but they could. So it depends on your risk tolerance of that sort of thing. Yeah,
I'll add that you want to check on how QSBS applies to safes. So I'm not a tax professional, so I'm not going to give advice on that. But, you know, my internalization of having read those is that 1244 doesn't apply to safes, and 1202 1045s would only apply after a safe converts. So the safe itself does not qualify for QSBS unless it converts, but only 1202 and 1045. I know people who are very, very averse to investing in safes, and there are various legitimate reasons for not wanting to invest. There's a fear that, you know, so as Alan said, you know, the safe is doesn't require that the safe convert. So you could have this instrument that doesn't gain any interest, doesn't have any terms or otherwise rights. And so if, let's say, at your safe investment, the company then just hits the hockey curve and goes really, really far, it may not convert. So, you know, that's a hypothetical, right? So you really want to think hard about all the what ifs. What happens if there's a subsequent investment? Will it convert? Will it not? What is the founder likely to do? What does a company exit look like? How does all of that work out? So there's lots of nuances here and lots of opinions that you will also find. So you know, you definitely want to study that and form an opinion.
Yeah, yeah, you bet. And you know, that's probably where we should stop on that topic, just because we could talk the whole hour about that part of things. So, yeah.
I have a quick question, if I may, before closing up on this topic. And is there such a thing as a collateralized investment in the angel investing world, in a similar way that there is in real estate? You can make a loan and you can collateralize it. Is there something like that in angel investing?
Try if you want to take it.
I have not observed such investments before. Neither have I participated in anything, nor have I seen investment terms where it's collateralized on some particular asset that the company has. That being said, you know, when a investment goes south and let's say the company completely fails, usually there's a process by which whatever remaining assets the company has gets liquidated and then allocated as per ownership in the company.
Yeah, I think, Sharad, if I remember right, I could be wrong, but I think you and I were investors in a company that closed. And I would say it didn't quite go to zero, but we got some lunch money back out of that, and a tax write-off.
Yeah.
Yeah.
Any resource you can point us to, whether that is a blog, a website, someone who where we can understand a little bit of all these legalities of of the different types of investment, whether it is convertible notes, things like that.
I think, well, Elizabeth, I think we have a bunch of some materials related to that it's already posted, right? We have some stuff. I think the answer is yes. Ramiro, we can find some stuff to send you that you could look at. So I'll just answer the question that way. I think we have some things that are already posted related to that, but we can help you with that, point you some directions.
We also have a session in a week and a half on our angel meetup that's posted, which actually talks about what are the important deal terms that you need to be aware of, and what are the ramifications on that. And I'll actually be facilitating that session with the guest speaker, so I'll make sure that he has a chance to answer some of those questions too. Would that be helpful? Okay. Right.
And Thomas brought up a good point in the chat about there's other models. So right now we're just really, the whole time we've been talking, we're just talking about, investing on convertible notes and getting payouts based upon the conversion and eventual sale of that equity, whether that's in the public market or private market. But there's other ways to invest as well, including revenue redemption, and there's other interesting things that you could do. And I actually think that if you look more broadly at these other ways of investing, it actually opens up a much broader set of companies that you might invest in that you wouldn't otherwise invest in if you were looking only at a narrow set of terms. And I think revenue redemption is one of those because, and we haven't talked about this, Rob, but I'll just start and maybe you can also pile on. When you think about equity investing at an early stage, in order to make the math work out, to generate, theoretical returns on it, you need to invest in certain kinds of companies, and those companies need to be companies that we tend to refer to as desiring to achieve venture scale. And venture scale really means that the company is going to get very big quickly, or as quickly as it can, basically. And then it's going to get very big quickly, and then there's going to be some sort of liquidity that occurs. So either that's because the company IPOs or because that company gets purchased by another company and you get cashed out as part of that. There are a number of companies that I've seen come through that are attractive with what they're doing, but their business model, their business plan, the way that they're going after what they're doing would not fall into sort of the venture scale category. But they could be interesting to invest in if you were thinking about it simply from the context of, say, revenue redemption, right? To say, hey, I'll invest, $100,000, making it up, I'll invest $5,000 in you, and I expect to get paid, that money to come back to me at a certain rate over the next 3 or 4 years or 5 years, whatever it is, or 1 year or 2 year, and at the very end of that, I get some portion of my money back or all of my money back plus a premium, plus I get maybe warrants or some other aspect on the equity side in case there is an equity thing, and I think that could be very interesting as well to invest in. And there are other organizations like Fledge, thank you, Thomas, that do that type of investing quite a bit. Sure, I don't know if you have you want to add on that.
Oh, that was such a comprehensive answer. Yeah, I've got nothing to add.
Cool.
Thank you for that. I did want to share a quick story of explaining why angel investing is awesome. So I'm actually from the venture capital industry. I cut my teeth in the VC industry 25 years ago, and I just got sick and tired of making too much money. So this was the dot-com boom days, 90, end of the 90s, and we were making stupid money. Like, put money in, it doubles and triples in a month. And we weren't really contributing to society, to the economy. We weren't really providing value. And after such frustration of really trying to figure out how to make this world a better place, I had to leave and start my own. So now at Mad Ventures, we do make good money. So we're trying to really change the world for the better. And I think that's the important task that angels are doing, and which makes angels real angels. Thank you.
Yeah, you
Thank
bet.
you for that.
That's a really great story, Thomas. It reminds me of a phrase that I heard during, I think that when I first got introduced to angel investing through SAC, which is that you can do good and do well, right? And if you can accomplish those two things, then you know, you're kind of checking the boxes. So yeah, I like that a lot. Any other questions?
So I'm going to jump in for a second. We like sustainable investing and the importance of doing good by doing well. And so we are actually hosting a session that's next week, actually, about how do you balance sustainable investing versus risk capital. And so there's an opportunity to come along and join us a little bit on that topic. Another person who's really big into doing sustainable impact investing in a variety of different areas is a woman. I'm just going to put her, Stephanie Gripna, and I'm going to put her link in here too, because she runs a variety of education workshops. Thomas, you know Stephanie, and some of the others. She's been a guest speaker with us beforehand, and she's invested with SAC. So.
All right, anybody have any questions? Otherwise I'll start picking on individuals and asking them what's top of mind for them.
We'll go to our question well.
Yeah. All right, let me just pick on someone. Nathaniel, do you have anything top of mind for you? How can we help you understand more about your angel investing journey?
Sure. Thanks, Sharad. I guess being at the beginning of my journey, I'm here to soak up as much knowledge as I can get, and I agree with what Alan said. It's instead of just paying money for a course where you get maybe a shiny piece of paper at the end of it, right? You actually are learning by doing, right? Which I know is a big tenet of John's, right? But I also think it's important to complement the doing part with building your knowledge base and foundation. So I'm curious, what are some resources you both have leaned on your angel investment journey, both books, websites, maybe other folks in the ecosystem whose knowledge and expertise you value?
Well, the biggest resource for me early in my career was SAC. Just multiple rounds of that, going to events like this where I just learned from speakers, but then just learning by doing. And through the process of evaluating companies, I learned a lot. First of all, you have to realize that the SAC funnel is really wide, right? You're going to see 50 plus companies each round. So you're going to, and each one of those companies, or some of them, they're going to pitch to you multiple times. So you're seeing pitches, like nonstop, and it's awesome, right? You get to see so much variety, and then you get to drill down on a few of those and really understand how that startup works and how to think about investing in that startup. And you get to look at it from the perspective of 20, 30 other angels who are thinking about it slightly differently. And after doing that so many times, that was the only resource I really needed at that point in my career, in my angel investing career. And then after that, continuing to invest with a team of others who are like-minded like me, who have an investing sort of maybe not as strong a thesis, but at least ideals as what I have. And we push each other because we're each writing our own checks. So there's no incentive that any one of us has in convincing the other of our point of view, other than educating each other. And so that in that process, I have learned a tremendous amount. And I've learned a lot also over time from, now that I have 25 investments in my portfolio, I get all these regular updates from the founders, and I learn a lot about how that journey is going, what has happened with their subsequent raises. sometimes they'll ask me for help with, hey, we are coming up for a new round. Let me do a pitch with you and give me feedback. Or we're running into this technical issue, help me understand how to deal with it. Through all of that process, I keep learning. So it's one of these things that just keeps on giving in terms of education that is really valuable to me.
I think that's great. I agree. And the same thing here. I've read books. I don't know that I can recommend one book over the other. I think Venture Deals by Brad Feld is a good book, but there's a number of books out there. David Rose has a good book. There's good books out there. There's a tremendous number of fantastic websites. People who blog and stuff that have a bunch of great stuff. Even though I don't agree with it, it's just great. People put a lot of great free content out there, so it's wonderful. But kind of the same thing. I came into SAC. I wanted to understand and really learn from that process. It took that first round. My second investment in SAC, I volunteered to be the assistant fund manager, as they call it. So I did that, and that meant that my third round through, I actually managed that whole process for SAC 13. And even as part of that process, because I wanted to learn, so much about what's going on, that I home rolled that investment, meaning that I set up the bank account. I didn't outsource it to a third-party firm that manages all the details. I did all the details. I set up the bank accounts. I negotiated the deals. I did everything, and I still do everything for that, which was just something I signed up for. Now I'm going to do it for 10 years. But I really wanted to learn by doing, Nathaniel, as you were saying. So I really got into that. And then, Sharad, you mentioned a really good thing about, investing with other people who are like-minded. And I know exactly what you mean, but I also want to point out that like when you invest with other people, they're like-minded, but they're also differently minded, right? So you're really trying to figure out, when you invest with other people, what experience and skills and talents that are unique or that are different from mine anyway, does these other person bring to the table? Because on any given investment, what's going to be clear is that you're not going to know everything about it. You're not going to see all the holes that are there. And really kind of not to sound, kumbaya-ish, but like the power of the team, if you will, is going to increase the chances, I believe, of having a better outcome, of having a more positive outcome over that, because you'll get the person that you're investing with who is a consumer marketing expert who has acquired 1 million consumers onto a platform before, or you'll get the person who is really good at enterprise technology related stuff. How do you build a product in the cloud? Or for some of the stuff that we're doing on the health side, for example, and I have a few health investments. I'm at a health startup right now. There's certain things in that I have no idea about. So I can think about it from a business perspective. But for example, on the health side, potentially there's regulatory stuff. So then finding somebody that you can work with who understands the regulatory aspects of that's going to be very, very valuable. So I really think that you find people that you like, which is important, that you want to be around, and then people who have different skills and experience and talents than you, and that's going to make a powerful team to invest with.
Yeah, I'll just echo one thing that Alan said, where I've had a really, really good exit on an investment where when I was looking at that investment, I didn't get it. I just didn't get it. Wasn't in my wheelhouse. But a colleague of mine is really smart, just really dug into it. And he convinced me and others that this is a really good deal. And so, quizzed him a lot on that, really, tried to understand his perspective. And I said, okay, I'm going for it. And yeah, that was really great. And if I was just listening to my own echo chamber in my head, I wouldn't have invested.
Yeah.
And who knows how many other investments that I have not gone into because my colleagues, rightly so, told me, hey, here's a big gotcha here that I would have been stuck in, right? Had I written that investment. So really, really love what Alan just said.
Absolutely. Question from Sam, Elizabeth.
Yes. Can you hear me?
Yeah.
Yeah. So Alan, you mentioned that you've gone through stages where you were the assistant fund manager in SAC. I was wondering, and I think you might have started to touch upon the kinds of things you did. I was wondering if you could talk a little bit more about what that entails, the kinds of commitments that you have to do and the kinds of things that you have to do that.
Yeah, you bet. So, so I was both from SAC. I was both sort of the assistant fund manager, which is basically just helping the person who's the fund manager, and so that's kind of the kindergarten step into getting into that. And then the next one, I was actually the fund or LLC manager for that part. There's work involved. So you can't go into it thinking there's no work involved. There's definitely work involved. And what you have to figure out in that process is, in order to make an investment, you need two things. You need companies to invest in, and you need other people to invest with you. So you need to create a pipeline. And so I'll use some other words here that we might talk about when we talk about investing, right? You need to create a pipeline, which is you have to get, find companies that you might be interested in investing in, and you have to raise capital, which meaning I got to go out and find other people who is willing to invest in this. And so within SAC, that's, you have a ton of support because it's kind of a machine that John has created that, that works to create those two things, but you still have to go out and find those, both the companies and the investors. So I think that was a great experience. How do you find companies to invest in? How do you create a pipeline? And then how do you talk to people about raising money, right? So people, at least, in sort of our, we'll call it, sort of the U.S. culture, they tend to talk about money in some ways and not in others, but you got to, find a way. How do you approach somebody? Hey, Sharad, I think you might be an accredited investor. You may not know about it. I think you might be because you work in this industry where the wages tend to be this. And based on that, I think you might be an accredited investor. Have you ever thought about investing in startups? Would you like to talk more about that? And so you might need to develop those skills to be able to do that. And I think that's something I got better at on both sides, or either built the skill from scratch or got better at having those discussions as part of the work with SAC. And then depending upon how much of the operations you want to take part in, you can be, I would say, as involved in those operations as you might want to be. So it tends to be that through SAC, we hire another company to help us manage all of that stuff. And so part of the money that comes into SAC gets used for sort of operational, it's a small amount, but for operational costs to hire another company to do that. And then you can be involved in that at a greater scale or a small scale within there, or you can roll your own. So that's what I did for SAC 13. That's what we did for SAC 12 as well. And that's what, I know Sharad has done some of that. Sharad and I together have home rolled some things as investors with other people. And so it certainly can be done. So you just learn a bunch of those things. So I hope that answers your question, Sam.
Yes, thank you. Thank you so much for elaborating.
Yeah. Ramiro.
Yes, thank you. A little bit related to what Sam asked, but perhaps a little bit more in the sense of time commitment. If you think back to the time when you started, participating in a SAC, so time commitment wise, in the spectrum of possibilities, from those who just raise their hand to say yes or no, to those who, in your case, Alan, that you invested, I assume, a ton of time, being an assistant manager, fund manager. So would you share a little bit of that spectrum? How does that look like depending on people's willingness or appetite for time commitment?
Yeah, that's a great question. And maybe, sure, what I can do as part of that, since I just spoke a lot, I'm going to ask you a related question, Ramiro, that I think it hits to that. So, Sharad, you had mentioned that you had both invested and not invested based upon some feedback, right? And I know from our work together, we've been involved in sometimes more and less due diligence on things. So maybe you can also tell me or give us an example in that way to talk about how much time, differences maybe in amounts of time you may have spent on one investment versus another.
Yeah, totally. And thank you for that question, Ramiro. So you're going to get out of this process how much time you put in. So, I've done SAC multiple rounds, and there've been rounds where, so to give you some context, I've continued to have a full-time job throughout my angel investing career, and I still have a full-time job. And so I really do this as a hobby, effectively. So whenever I can squeeze time out, I go look at companies and I decide to make an investment. So when I participated in angel investing in SAC, in some rounds, I was really, really active. I was there in every single meeting, spending a whole bunch of time reading up about all of the companies that have applied, doing research on what does this industry look like, what does the market look like, how should I be thinking about this, what are the questions I should be asking, talking to other angels one-on-one outside of the meetings, and then also going on to be assistant fund manager. But then there have also been one or two rounds where I started, I made the investment, but then I realized, oh crap, there's all this stuff happening at work. I can't really squeeze more time out to spend more time on this. And so I didn't. And that was fine, right? So that, I thought of that as like a gap semester where I didn't really put enough time and effort into it as much as I wanted. But then I made up for it in the subsequent semester where I started looking more carefully. So it's really, up to you, as much time and due diligence as you want to spend. But every time that I've spent my time and effort, I've learned so much from that, even when I decide not to make an investment, not to pursue it, because I've learned so much about that particular space that it helps me make subsequent good decisions. The other thing that I've also done sometimes is I've come across companies where they're just not at the right stage for me. Because when I look at a company at this stage, there's of course a whole bunch of gaps. There's a whole bunch of holes, right? They're at an early stage. There's so many unknowns. And one of the key skills that you build as an angel investor is to reason about those unknowns. How should I think about this unknown? Is this a fine unknown for me to take a bet on or not? And is this team of founders the ones who are going to be able to fill those gaps when those gaps become a blocker for the company? And sometimes I feel like those gaps are not something I'm comfortable with, so I don't invest. But then there's a subsequent round that comes up, and usually at a higher valuation, right? And so the risk-reward trade-off is different, where they fill those gaps that I'm really concerned about, and all the other gaps are ones that I'm totally okay with. And sometimes those investment decisions are a lot faster for me to make because I've already spent all this time and effort in looking at this company. So there's a lot of value, I think, in spending a lot of time and effort. But again, modulated against what your other commitments are, and you'll get some value out of it.
And Sharad, follow up. Thank you for that. That was very thorough. Just follow up. I'm looking here at what Elizabeth wrote on the chat. Investors 2-3 hours a week in meetings plus homework and things like those. Is this something like investment banking where suddenly you have a peak and if you really want to get the most of it, you need to invest a ton of time that 1 week and then it might level off, or is this a thing that you can adjust to your schedule and say, well, I'm gonna think about, from a planning point of view, I'm gonna think about 10 hours per week, right? However, I can put them on my schedule. Would you share a little bit along this line?
Yeah, I can say a little bit, and then I'll hand it off to Alan. So I'll give you two perspectives. One is going through SAC, and the other one is doing investments outside of SAC. So when you're doing it through SAC, there's a process, right? There's a really clear process. You know what the timeline is, so you can manage your time accordingly. So, think about all the different stages, reviewing all of the profiles and gusts, making that initial cut, and then seeing pitches and so on until joining a due diligence team and focusing on one company, right? So you can allocate your time according to your expectations. Now, when you're outside of the SAC process and you're off doing your own investing or investing with other colleagues, it's not a semester-like system with SAC where companies apply and then you make a decision across all the companies. You're just getting continual deal flow, right? And sometimes you're going to get companies that where there's a lot of time because they just started their raise. It's going to take them several months to complete the raise. So you can take your sweet time in really thinking hard about the company. But there are going to be other times where you're going to get a really hot company. Wow, this looks amazing. It's right up my alley. I believe in the founders, but I've got to make a decision in the next 3 days because the round is closing and they're probably going to be oversubscribed. So then I'm like, oh, wow, I gotta, spend a whole bunch of time, stay up all night and read about this and really come to terms with whether I want to make an investment or not. But again, it's your risk, right? So you can choose not to do that. And so there's no pressure other than your own pressure that you're applying to yourself. What do you think, Alan?
I think that's exactly right. I think there's definitely been times when, with SAC, for example, for sure, there's a process, right? So you're going to have an amount of time that you're kind of spending on that. And then when you get to DD and how you're participating in diligence, there's going to be a spike right there. But I agree. To me, it's kind of what you put in, you're going to get out. So if you put in a bunch of effort and time into it, you're going to learn a lot about it, and sometimes you have the time to do that. And sometimes you don't. And there's certainly been times when something's come up where I've spent a lot of time on something, and other times where something has come up and, kind of like try what you kind of mentioned before. It's like, well, I have a very short period of time to make a decision on what's going to happen here. And for me, I don't like to be pressured that way, if you will. And so to me, it becomes like just a binary decision. I'm either out, not enough time for me to think about this, or I just say, I'm in. I'm not going to think about it any further. I'm just going to come in, and I'm going to do that based upon, a connection, because, Sharad went in, and we've known each other for a while. Maybe that could be it, right? Or because, I know a little bit about the company and I'm just going to go for it, and I guess that gets to another point that's I think very important, because we talked about sort of portfolio and allocations and stuff like that. Every time that I make an angel investment, I already put into my head that this thing's going to zero. and so that helps me to not worry about it at all. And so I put in my head it's going to go to zero, and that the fact that this went to zero is not going to keep me up at night. It's not going to bother me. It's not going to mean I can't buy groceries or something like that, right? And so that's just kind of how I mentally treat it for my own sanity. And if it was going to keep me up at night, or if it was going to cause a problem, then I wouldn't make the investment, and then I make that decision and move on from there. So that kind of tends to be how I look at that.
And for those who are looking practically at their calendar, I actually put the SAC schedule in there for the next little bit so that you could have an understanding on. And those are the same process, but slightly different dates will run for TAC. But you'll see we do a lot of screening at the beginning, which is why if you're looking at 60 companies, that takes a little bit of time to go through them. But you're really at that point in time doing your early blush. Is this an interesting space? Do I like the area that I want to work in? Does it fit within my investment thesis? And then towards the end, when you're really into that due diligence with working with 5 or 6 other people on a team, people who've been on the due diligence, will say that it works better if all of the people who are the investors in the due diligence participate in. And here's Elaine. This is perfect for you to jump in, because you've done 13 due diligence, 14 maybe. Okay.
Yeah, since SAC 7, I've been an angel investor. Love it. Always learn something new every time. Sometimes I have spent more time, sometimes because of travel for work, I've spent less time. But each of them, I felt I've learned something and been able to get to the end with an investment that I was excited about putting in my portfolio. So my question to Sharad and Allen is, as a fund manager or assistant fund manager, what are some of the things you felt you took away from that experience on your journey? That's something I haven't done. Love to see that you guys have a window into that, and would like to hear kind of what your takeaways were.
Sure, can I pass this to you briefly? There's something I need to.
No problem. One of the things that I've learned as assistant fund manager is all the things one has to do to make a fund be successful. And I say that with some modesty that, we're talking about a SAC fund, and I'm not talking about a VC fund, but you just get a little bit of inkling into that, which is, as Alan said, finding LPs, right? The angel investors who are going to write checks, so hitting the pavement and talking to them, finding those companies, your deal flow, right? All the companies that will apply, they'll be part of your funnel, and then thinking about the process. How is it that, what are all the legal instruments that we're going to go through, potentially negotiating the terms of the investment into one or multiple companies at the end of SAC, the tax process. So, all of those were very educational to me, not only from a SAC point of view, but subsequently in Grub Stakes, we roll everything on our own. Like, we have our own legal agreements for forming a syndicate. We form our own LLCs in Washington State. We do all of our taxes ourselves, like everything we're doing ourselves. And so that gave me really valuable insight going through that at SAC. And since then, I have also seen presentations from VC fund managers about all of the process that they've gone through. And I have a much, much deeper appreciation for how much work and effort that is, and how much stress that is as well.
Thanks, Sharad. That's great.
Any other questions anybody has? Oh yeah, Ramiro, please go ahead.
Yes, in the angel investing world, are there such things as a quality of investment compared to? I mean, Sharad, you have invested in real estate, so so imagine, when you go to auction and there are big funds there that take over the best deals. So is there something like that in angel investing, and how do you typically go about that?
Yeah, so that's a great point, and it makes me think of the deals that got away that I really wanted to be a part of. There's certainly times when you come across deals that are very, very hot, they're oversubscribed, you really are passionate about the company, the team, and investing, but you're just not able to squeeze your way into that investment. I've certainly had multiple occasions of that. There are times when I can think of, for example, when I was down at YC Demo Day, can think of multiple companies, but one in particular stands out where they were doing something in a space that I knew a lot about. It was a problem that I wanted to solve because it was a problem that I had experienced in a prior product that we had built and shipped. And I had wished at the time that I wished there was a solution out there for this problem. Boy, it'd be great if somebody were to go build it. And then I see this company that's building it, and I talk to the founder, and it's like, wow, this is an amazing founder, has all the right experience, is thinking about this exactly the right way. I want to write a check. I want to be a part of their journey. And I couldn't, because by the time Demo Day had happened, they were already oversubscribed. So yeah, there are certainly like deals out there that are quality in that sense, and I've continued to follow the founder and the company, and they've continued to do really, really well. But I take solace in knowing that there are lots of startups out there. There are lots of founders out there, and if I miss out on some, that's okay. I will go find the next great founding team and company, and I'll go invest in them. So I don't feel, while I feel bad about losing the ones that I really wanted to invest in, I don't feel an internal pressure to quickly deploy my dollars, because there's lots of other avenues that I'll make my dollars do for me. And so I invest opportunistically. When I see a great deal with a great team, then I invest. Otherwise, I don't. So yeah, so there certainly is like a quality, and that quality is in the eye of the beholder. There's some companies where I valued a lot more than some of my fellow angel investors have, and vice versa. And part of that is just my own internal metrics of how I evaluate a company, but also my lens of my experience that is different than someone else's. Great. John?
Thanks, Sharad. So now that I have a handful, maybe half a dozen investments, and after participating in the first APIS Health, I'm starting to put more thought into how I focus my thesis of investing. I learned the reason I chose to participate in APIS Health was very much for the educational opportunity, for learning about that as a vertical and as an industry. And now I have an investment in that space, but it feels like in that vertical in particular, just as an example, the risk of any one investment being successful is lower than perhaps in a software as a service space, just to throw something out there. So I kind of wanted to ask you and anyone else who had experience with, as you're progressing with more and more investments, how have you found the need to, if not, maybe you have, focus your thesis in on particular verticals so that one investment in a vertical is sort of just a random event versus multiple investments in a vertical. And I know that as you build your thesis, you can think about the kind of founder you like, a woman founder, for instance, or if you are an impact investor, that there's a level of good that needs to be done. But I'm just thinking about the sort of the business vertical and the space that they're playing in.
Yeah, that's a great question. And the way I think about it is, as I have built my portfolio, I have learned some things about certain verticals that allows me to de-risk some verticals for me, because now I understand how this business or this market segment works. So I can ask the right questions and tease out whether the founding team will be able to deal with certain roadblocks that are inevitable in this vertical. And so that gives me that insight that I hope will give me a better chance at making a return in a certain vertical than otherwise. That being said, I personally don't focus myself too narrowly into a certain vertical. And the reason for that is multifold. One is that I do enjoy learning. And so as I invest in multiple verticals, I learn more from these other verticals than ones that I've invested heavily in. That's one reason. The other reason is it's tough to invest in a company where you already have another company in your portfolio that's doing almost exactly the same thing. Okay, there's you want to be legitimately concerned about being able to, separate yourself out, and that's very hard to do. And so anytime I get a pitch or a request to pitch from somebody who's working in a particular space, I disclose to them, look, I'm already an investor in this other company. I don't know if that's a conflict of interest or not. And so I want to be upfront and clear about that. And I also want to, even if they say it's fine, I want to be clear for my own sake, for my own conscience, as to whether that's the right thing for me to do or not. So there's a little bit of a boundary that I have to think about and navigate for myself. And that's up for each individual to decide how narrowly they want to focus. I don't know if you caught the question, Alan, if you have any thoughts on that.
I did not catch the question. So if I got the tail end of your answer, but if somebody wants to repeat it, I can maybe provide a little bit or a quick version of it.
I don't, I'll repeat the question, but I think it was a great answer. But so Alan, it was about sort of a diversification of verticals. We've talked about diversification of dollars based upon total net worth, but as you continue to be an investor, how do you diversify your verticals?
Yeah, I mean, I would say maybe a little bit contrarian about that. I don't believe in diversification in sort of the standard way that people tend to think about diversification. I think if you want to achieve market returns, then just invest in the broad market and get market returns, and then you never have to worry about it again. This is just my opinion, by the way, so it's kind of take a grain of salt. If you want to achieve outsized returns, then you have to do things that are different from the market, right? And so I tend to think about diversification a little bit differently than maybe is the way that people tend to think about it in a standard sense. Yeah, so I don't have a particular sort of investment thesis, that I only invest in certain things or other things. I do tend to, I probably am attracted to things that I kind of know about. So I think that's generally a lot of people do. I've been working in the, sort of software industry most of my career. So I kind of know about how that works. And so I'll look at those things. There's an inverse situation that happens there too. And Sharad's probably experienced this, which is that you see those companies, and because you know about that, or that general space, you poke a lot more holes in that, and things just look less attractive because of that, because you see all these potential issues. And I'll say, and I'm sure Sharad has done this before too, but I've invested in things, companies that are doing things where the thing that they're doing, I literally know nothing about that thing. And so I'm really just looking at the business fundamentals, researching the market opportunity, and in some cases relying upon input of other team members who know something about that, and then helping out where I can and other things. Sort of, maybe go to market is go to market no matter where you're at, which is not entirely true, but yeah, things like that. Maybe I can provide value on something interesting, but yeah, that's how I tend to think about it. Dennis has his hand up.
Yes. So like I mentioned, I have been through SEC 19 and the EPS this year. So just wondering what would be the best approach to continue learning, and how do I invest my time as a sophomore, I guess. So what would be the pathway or whatever recommendation you might have for the second years to continue the angel investing? Of course, we need to do the diversification, but do we need to stay with one organization, one format, or we just try to explore a little bit more? If we need to explore a little bit more, what would be your recommendation to do things next, for the second year of the angel investing?
Yeah, you bet. I mean, I would say that as somebody who, again, like Sharad, started as a member of SAC and angel investing, and I think back to that very first round that I went through and all the things I learned in that first round, that was truly like, at the end of that, I felt like, okay, I can conjugate a very simple sentence now in this space. And I feel like I already had a decent finance background, so I understood the broad sense of things. But still, I'm barely speaking that language at the end of that first round. And so I felt like it took, a couple of 2 or 3 times through that to where I could start to focus on some different aspects of things. Like I laid a foundation here, now I can focus on this part, this other part, to really, learn more and really raise my own education level in that regard. And then, there's a lot of other people. So, as Sharad mentioned, some folks have gone on to do other things like through grub stakes, that sort of a thing. You start to learn more through that. And then, you can become involved. There's many angel groups, and maybe Elizabeth, we can share out, some of these as well. But, some of the easy ones that come to mind are Alliance of Angels and Keiretsu are just 2 that come to mind that are fairly easy to get involved in if you want to be involved with them. And there's many others that are out there as well, other than those ones for sure.
Yeah, I would add that, with all these groups that Alan mentioned, you can audit, right? You can go spend some time with them, learn about the process, try and really think hard about how is this group and their process different than some other group. Is their deal flow different? Is the way that the team evaluates a company different? And so that in that process, you will also learn for yourself, what are the things that I like and what are the things that I don't. There's certainly some angel groups where the process that they go through, I have an allergic reaction to. And I'm like, yeah, I don't want to be a part of that. And then there are other groups that I look at, it's like, yeah, that's a really, really nice process. And I really like it. So think about that, and think also hard about what screening looks like. Is the deal flow something that's available to all angels in the group, and then they can go make an individual decision? Or is that deal flow a closed process where there's a select committee that first does an initial screening to filter out a set of companies that don't match some criteria, and then only the rest is seen by the angel team? And that could be a good thing or a bad thing depending on your point of view. The good thing is, well, now you see only the cream of the crop, and maybe your time commitments dictate that that's what you want to do. But for others, you might be thinking, well, wait a minute, that might be weeding out companies that I might otherwise be really interested in. And so you want to think about every step of that process, what that funnel looks like, what is the value that the angel group or fund that you join is giving you.
Yeah, and to add to that, just sort of in full disclosure, in the context of being frank, there are some people who don't like the process of SAC, the SAC process for evaluation and choosing the investment and that sort of thing. And so, people are different in how they want to interact with that. And I think it's important to find, try, as you mentioned, a group that kind of aligns with how you think about those things, so.
Yeah, thanks for the tips, Allen and Sharad. I already participate in the Alliance of Angels and Caruso. So, but again, it's a good experience to explore different kind of format, different kind of philosophy. I'm just wondering, maybe Sharad can share a little bit more about grab stakes. What's the philosophy? What's the approach? And maybe how does the thing started with grab stakes?
So I can tell you, I'll start with the latter, which is how grab stakes started. At the end of, I guess, my 5th or 6th SAC round, I was thinking about my angel investment journey beyond SAC. And there were a few others who were also thinking about it the same way. And so we decided, well, let's get together and make a plan, right? And so we made a plan for how to go about it. And you had to think about everything. Like, you had to think about how are you going to get deal flow, what company are you going to use to form a syndicate, or are you going to roll your own, and taxes and all of these things that SAC to a large extent, gives you, right? And so once we did that, we formed and we told others that we had invested with, and they joined us. And our process is the following: we're a membership, nothing more. We're all people who know each other in some way or the other, 1 or 2 degrees apart, and we just share deal flow. Here are the companies that we've heard about. Here are the people amongst us who are really interested. Let's go talk to the founders and dig in. And at the end of that process, if we think we want to make an investment, then individual people say yes, raise their hands, say, I'm going to invest, and this is how much I want to invest. We let others in grub stakes know. And then that way, others who didn't have the time to really do due diligence, they can go look at this and say, yeah, I'm going to follow as well. Okay, and then if there's enough of us, then we'll form a syndicate, and we now have our own process for doing that. So that's roughly how we work. There's no fees or membership dues or anything like that. We just split the raw costs of forming the LLC and the taxes amongst the members. So that's what our process looks like.
Perfect. Thanks for sharing.
Sharad, a quick follow-up on that. It does sound like you create an SPV for those people who are interested, rather than asking individual members to make individual investments. So at grub stakes, what's the requested minimum that somebody would make as part of the group's investment?
Yeah. So as you know, most startups will take a minimum check size of about 25K. There's no hard and fast rule, but that's typically the minimum amount. And we found that for us, the math for doing a syndicate doesn't really work out until you go beyond 50 to 100K, just because there's some costs involved with registering the LLC, keeping it renewed, doing the taxes, all of this, keep maintaining a bank account. So if there's enough interest among members to get to about 100K with several people, then we'll form the SPV. Now, as to the minimum check size, we don't have a minimum within the syndicate, but I would say that it probably doesn't make sense to write a check less than 5K because the overheads of all these fees for LLCs and so on it just eats into your check size, and so you don't want to do it if it's less than 5.
Is there a membership fee to be part of Grubstakes?
No, no membership fee at all. The only thing that we ask is we have a set of values on our website, and those values are really founder-facing, which is that we're here to help founders. So even if we don't invest in a company, we still want to provide whatever advice we want to give them, but also just be really mindful about it's the founder, the set of founders that are going through a journey, and they're the ones who are putting their skin in the game. We're merely writing a check and providing whatever advice we can whenever we're asked, right? It's really the founders that are putting in their sweat and their skin in the game, and so we have to be really respectful that they know a lot more about their business and their startup than we do, and we want to be mindful of each other as well, in that each angel can make their own decision about whether to invest or not, and they could be equally right or wrong as anybody else. So they're just basically a set of values that we have that you have to agree to, and that's really the main thing.
Yeah, I find that to be very good and very similar to how SAC operates, and sort of make sure that you're helping other investors and make sure that you're helping other founders, no matter what the actual experience of working with those companies is or whether or not they get an investment. So yeah, it's one of the things that makes it a satisfying experience for me, even if the company that got the investment wasn't necessarily the company that I had fallen most in love with.
And that's very good, Sharad. Thomas over here. If you have any good opportunities, we would love to co-invest. So look us
Fantastic.
up with those opportunities. Thank you.
Thank you for that, Thomas. Yeah, actually, we found a lot of value in working with other entities in the ecosystem in both directions. Like, we've gotten some really interesting deals from other entities where either the other entity said, look, this is not the right stage for us. We tend to invest in a later stage, but this might be really interesting for you. Or we've also had cases where the other entities like, look, we're writing this large check. There's just a little bit of gap left. This might be right up your alley. And then we get to, with the founder's permission, the other entity might share their due diligence effort with us. And that significantly cuts down the founder's time of having to repeat the same questions and answers, right, that they've already done with the other entity. And then we can come to a quicker decision. And so it's like a win-win. And so we really enjoy working with other entities in this ecosystem and co-investing.
Well, it's often that we don't fill a full round. And so, for example, we just had a company come through both SAC and APIS, and they filled their round 2.3 million with a number of companies that had actually been participating in our space, and that would be our company Violet. So thanks for Sharad for putting in your information about Grubstakes, and we know Javier is with you along, another SAC person, and we love to see these alumni funds. I think John has been very pleased because his focus is to get startup investors in here and keep them in the system. And if the system looks like it's better in another port for educational, then to have these investor alumni companies and groups. It's lovely to see, and big champions. And so we appreciate the counterbalance back and forth. And we'll sing your praises too. The other is, I would like to just say, are there any other questions? Kristen had one that we haven't really addressed, which is, has anyone done some investing through a Roth IRA? I gave her a document that comes from the Angel Capital Association, but is there anyone who's done this specifically who could offer some advice?
I have not invested in private placement within those other vehicles.
I have not either.
What will be the gist of that document, Elizabeth?
It actually is just how to use your Roth IRA for others. And now that I know that she could open it, because it is a resource for ACA members, and I wasn't sure if Kristen could open it, but I'll just pop it back into the chat here for everybody. It's specific to a specific company that's offering that service. And there are other companies that also offer investing through your Roth. So we've got a bit of an opportunity to give about 15 or 20 minutes back to people. If you have other questions, we'd be glad to answer them. But otherwise, what I'd really like to do is to say, Allen and Sharad, thank you so much for your time and your thoughtfulness of your responses to everybody. I love how you played off each other and asking each other questions, because you really have been doing this together and separately for a long period of time. And that camaraderie, what Elaine once said is, I'm doing it, 1, for education, 2, for seeing the opportunity to make some money, but 3, because it's actually quite a social networking here. And you have you can really bounce ideas off each other. Why did you think that was a good company? Why did you think that wasn't a good company? So that network, which everybody gets the opportunity to do so, is really helpful here.
Well, come visit our YouTube channel and we'll talk more about it, right?
Sounds good.
Yeah,
Thank you,
very much.
everybody.
Yeah,
Thanks, guys. That was great.
Questions.
Great to
Thank
see
you.
you.
Thank you so
Good
much.
to see you too,
Hey,
Ellen.
guys.
Yeah. Elizabeth, this meetup is international because I'm connected here over from the Canadian side.
There we go. Yeah.
And and
Love
I'm a
it.
Canadian too, so I love it. Yeah.
Excellent.
Thanks, John, for remembering
All
that.
right. Thank you, everybody.
Okay, take care.
Thank you.
Thanks all.
Bye.
Okay.